the monthly job data out of the US. And I think that's equally important. I mean, if the RBI decision is important for the Nifty, Bank Nifty, I mean, I think that is the one which will determine what the global risk-free rate, which is the US bond yields, will do from here. So that data we get right before US markets open. Varun Lohchab is with us. He's head of institutional research at HDFC Securities. Varun, good to have you with us here. Thank you very much for your time. Just a quick word on the RBI, if anything stood out to you from that before we go any further.
Good morning, Prashant. No, I think the policy meet was frankly a non-event, largely on expected lines. We were expecting rate pause to continue. However, we believe that this rate pause could be an extended one, and it would be easy to bring down the rates. If anything, I think risks are still marginally to the upside, given how bond yields are shaping up globally, and given how inflation has been very sticky. But for the time being, it looks like largely on expected lines. I think the economy is doing quite well. So the good part is the economic momentum continued into Q2. When we look at high frequency indicators, July, August, September, that continues to be good. Crude remains a key monitorable. As long as it doesn't reach 9,500 levels, I think we are okay overall. So, yeah.
Varun, hi, good morning. So, I mean, this is one event out of the way. Next, global, as Prashant mentioned, obviously is the jobs report, and we'll keep watching what's happening to risk assets in the West. But then here, earnings season is starting. So give us your sort of top-down, bird's-eye view. What expectations are you getting into this Q2 season with?
Yeah, I think overall, earnings season should be a reasonable one. I think the issue this time around is the timing one, that festive demand will largely come in Q3 because of Diwali being slightly late compared to, say, some of it in Q2 in the base year. So some of the consumer durables or auto companies might not have optically numbers look as strong. But I think if you look at expectations from the festive season, they seem to be overall reasonable. The consumer sentiment, the overall buoyancy in the economy, as I said earlier, is fairly good. Rural still continues to struggle a little bit, but even out there, despite monsoons being below par, we are not seeing a very sharp deceleration. It's just that the acceleration or the improvement which was expected is getting slightly delayed, but there is expectation of a mild recovery in H2. Banking, which is one of the large sector, will see some sequential NIM contraction. So that is something again largely known, but will put earnings under pressure. On a YY basis, financial will still report a good growth. So I think overall for this year, we are expecting around 18% earning growth. And Q1 was obviously very high on a YY basis to the tune of 45-50%. And this quarter will also be, a healthy 20% plus kind of a number in our view at aggregate Nifty earnings.
Got that. So 18% for the full year. Q2 will be about a 20% earnings growth. Varun, what's your read-through from the business updates from the FMCG companies? Marico spoke about a low single-digit volume growth. We had GCPL today. They're talking about a mid-single-digit revenue growth. What have you gleaned out from the demand trends based on these business updates, and how are the stocks positioned?
Yeah, so I think again fairly consistent and largely on expected lines. If you look at even in our conversation with say HUL few weeks back, the same point was being made that rural demand is largely on stable on a Q-on-Q basis. There is no improvement. There is no sort of deceleration. However, a lot of these companies have taken some price cuts in last 3 to 6 months, given the falling inflation, and they were expecting some degree of volume recovery to compensate for those price cuts, which has not happened. So given that, I think the top lines are slightly on the lower side. If you look at for what we expect for HUL, for Marico or GCPL for this quarter, volumes are largely flat on a sequential basis. They should have improved a little bit, but as I said, things are getting delayed on the recovery front on rural. Margin should be fine for all of these companies. So operating profit growth or EBITDA growth should be in low double digits for most of them. So I think it's just that FMCG right now does not offer a very strong growth relative to rest of the market. The sector aggregate earning growth will be close to 10% whereas, as I said, market earning growth will be 20% plus. So it doesn't look as attractive. Valuations are not too compelling either. They are still a bit high on the absolute basis. And therefore, I think it's a case of this being a defensive sector right now, maybe not giving you too much absolute upside. But as rural recovery comes in second half, you will start to see some positive uptake. So we are still underweight in our model portfolio, but not overly negative now, the way we were in the last 2 or 3 years, given the relative valuation gap they had with the rest of the sectors. I think other sectors have caught up. FMCG has largely gone through consolidation and time correction.
Varun, what are the top ideas you're pushing to clients? I mean, when clients ask you, well, we're sitting on some cash and we'd like to deploy it, what are you telling them? Doesn't have to be large caps or, market cap agnostic. What are top absolute return ideas?
So, we have ideas actually across sectors and across market caps. We are not overly worried on one segment of the market as of now. Actually, I think after a fairly long time, from a market perspective, we are in a situation where earnings have normalized for almost all sectors. So we are not sitting on very depressed earnings in any of the sectors. So easy money is not there, nor are we sitting on very depressed valuation in any of the sectors. So now it becomes a classical bottom-up, story where you have to pick individual stocks. Among the large caps, our preferred theme still continues to be more economy-facing. So you have capital goods, power, construction. The top picks out there among the large caps are L&T. Among the small caps are NCC and Ashoka Buildcon. Then among some of the mid-cap sectors, exchanges has been one of our sort of preferred sectors. So we like both BSE and MCX out there. Among the financials, we are still sticking to Axis Bank, ICICI and SBI as the top 3 picks. We are not going down the market cap curve too much, barring say Bandhan Bank, which is among the mid-cap banks, the only bank we have in our model portfolio. Then pharma as a sector, we have been positive on that for last 3-6 months. We believe the improvement in earnings which we have seen will continue out there. Cipla, Sun Pharma have been our top picks for quite some time. Cement, we are neutral. Metals, we are underweight. And consumer, as I said, both staples and discretionary, we are underweight. Autos is one sector where we have incrementally taken some money off after the very strong performance of the companies out there. Our top picks have been M&M and Bharat Forge.
Okay, that's a sort of exhaustive list, but helpful. Thanks very much, Varun, for joining us, and hope that conversation is useful for our viewers as well. Thanks indeed with that perspective. Well, we've got the market, which is up